It is a pleasure to introduce our next instructor here at Best Ideas 2018. Joining us from Chicago, Barry Pasikov is managing member of Hazelton Capital Partners, a value-oriented investment fund which he founded in the year 2009. Hazelton Capital Partners employs two investment strategies. The core strategy constructs a concentrated portfolio of equity holdings that are selected based on a number of metrics, including sustainable revenue growth, margin expansion, the company's balance sheet, and the company's management. The overall strategy, through its use of options, commodities, currencies, and risk arbitrage, complements the core strategy by providing a hedge as well as short-term cash flows. The fund, Hazelton Capital Partners, is a distillation of Barry's 20-plus years of experience in equities, currencies, commodities, options, and portfolio and risk management. On a personal note, I've had the honor to know Barry for quite some time, and I truly respect the way he manages money and admire him at a personal level. So we are truly grateful to have you here, and it's an honor to welcome you to Best Ideas 2018. Please proceed.
All right, well, thank you, Shai. And I want to thank Manual of Ideas for inviting me to speak at this year's Best Investment Conference. And as you mentioned, I've been involved with Manual of Ideas and its conferences in the past, and I've always been very impressed with the seminars that you guys have put together and also the caliber of the content as well. So this is my Don't Sue Me page. This is just for educational purposes only. This kind of covers what Shai had just gone through. The one thing I would say on top of this is the strategy that we use, the investment discipline that we maintain, as well as the portfolio management, this is how we feel we're going to outperform the market in the long run. And Hazelton Capital Partners recognizes that for a value investor, you're kind of in a challenging environment. There aren't a lot of very cheap or there aren't a lot of names out there that are just popping up as great investments. And even though this may be the case, and we have to temper our returns, the quality of the companies and their management that we invest in do not change over time. So our main focus is always to focus on the downside with the belief that if we can get comfortable with the potential downside of a company, then the upside over the long run will take care of itself. So the topic of my conversation today is called Hidden in Plain Sight. And this really references a short write-up I did for Manual of Ideas entitled "The Next Big Thing Just Might Be Hiding in Plain Sight." In the article, I pose a question. What is going to be the most dramatic change to our society over the next 10 years? And which company is going to benefit from this next big thing? The market and the media really love this investment strategy. They want to know what industry is going to be disrupted, and more importantly, which company is going to be doing the disrupting. And there are a number of investors out there who are very successful using this strategy. I'm not one of those guys. For me, there's just too many variables I don't know, and I have no competitive advantage doing it. So instead, I like to invert the question. What is not going to change over the next 10 years? And which companies will benefit from that? In 2006, I invested in a company called Sherwin-Williams. And Sherwin-Williams is a 150-year-old paint and coatings company. My thesis for the investment was pretty straightforward. Sherwin-Williams, its brand, its industry would continue to grow steadily, even during market cycles that we've seen in the past. Not by the double digits that maybe the market would hope it would, but at the same time, there was very little risk of disruption either from a newcomer or a new technology. However, by 2011, as the market continued to recover, I decided to sell my position. It wasn't that there was anything wrong with Sherwin-Williams or any changes within the industry. I just started becoming impatient. And from everything that I was reading as I continued doing my research, I was being influenced that Sherwin-Williams just wasn't growing fast enough and that its margins just weren't expanding. The truth is, after looking back at that investment, I didn't truly understand the company I had invested in. So let me be clear about that. In terms of the fundamentals, the financials, the research that I did, the analysis, I truly felt comfortable with what I did in my investment. However, when it came to understanding and taking time to think about how Sherwin-Williams and its management would look and operate over the next 10 years, I really didn't spend enough time doing that. And that's what really turned out to become a costly mistake. What I failed to appreciate is when you combine a company with significant cash generating power and a management team that is focused on creating value for the company and its shareholders, this creates a very disruptive and profitable combination. If I had held my Sherwin-Williams position from the time that I bought it for 10 years, it would have returned over 680%. That would compare to Apple at the same time, returning about 610%. That 680% included about $2.3 billion worth of dividends, about $5.1 billion for buybacks, and a free cash flow that grew from $550 million to $1.4 billion. It turns out that Sherwin-Williams was hidden in plain sight, mostly because it didn't fit into any investing strategy. It didn't have the significant growth that growth investors were looking for, and it wasn't cheap enough for the value guys. Now, I'm not going to be presenting on Sherwin-Williams today. However, the company I will be speaking about has a lot of the similar characteristics that Sherwin-Williams had 10, maybe 15 years ago. The company that I'll be talking about is also hidden in plain sight, and that's Hanesbrands. So, Hanesbrands is a leading global consumer goods company that designs, manufactures, markets, and distributes innerwear and activewear. And just so we're all on the same page, innerwear is underwear, and activewear is the sports, exercise, and outdoor apparel that you wear. For a quick history lesson, Hanes was founded in 1901 as a men's sock and underwear company. Over the years, it expanded into women's bras, panties, and hosiery. It also included children's underwear as well. By 1979, they were acquired by Consolidated Food Corp, which later changed its name to Sara Lee. In 2005, under new management, Sara Lee decided to focus purely as a food, beverage, and household products company. And any division or segment that didn't fit within that platform was to either be sold or spun off. So in 2006, Hanes was spun out of Sara Lee and saddled with $2.5 billion worth of debt. The debt was for a one-time dividend that Hanesbrands paid back to its parent company. So the first order of business for that management team was to delever the balance sheet. At the time that it went public, Hanesbrands had a market capitalization of $1.9 billion and a debt level of about $2.5 billion. Starting in 2006, they began to delever that balance sheet. And they did it through 2009, closing 12 plants and reducing employees by 10,000. Between 2006 and 2012, they were able to reduce their debt from about $2.5 billion down to $1.3 billion, getting it into a net debt to EBITDA ratio of about 2.5 times. The company is basically put a range where they want to see their net debt to EBITDA between 2 and 3 times. Starting in 2013, the company, feeling more comfortable with its balance sheet, started doing some acquisitions. And so from 2013 through 2016, they did 5 acquisitions and paid about $2.5 billion. One of them, DB Apparel, was actually a group of European innerwear brands that Sara Lee had, but instead of spinning it off or including with Hanesbrands, they sold it to Sun Capital Partners in 2006. So Hanesbrands bought it back in 2014. Also in 2013, the company started issuing a dividend. And today that dividend has been raised, it's been raised every year, and today that dividend is around 3%, maybe just shy of 3%. 2015, they started buying back some shares, and they've been buying back shares every year since then. This slide gives you an idea of the brands that fit under the Hanes umbrella. And this is the segments that and the brands that are associated with those segments. These are the North American brands that they have. Hanes does 75% of its own production, either in-house through its own plants or through dedicated contractors. The remaining 25% is outsourced on a year-to-year basis. What this does, it provides them the flexibility to be the low-cost producer, but also to manage their inventory in a very proactive way. They also have 44 distribution centers throughout the world, 15 of those in the United States. And again, that part of it is purely about inventory management. One of the things to understand about Hanesbrands versus other apparel manufacturers out there is that they don't work on purchase orders. They work on replenish cycles. So as they deliver inventory into Walmart and Target into JCPenney, they don't get another purchase order for that. What happens is they get a call and it says, we need a replenish of inventory, and then they have to deliver it. So they always need inventory on hand. And sometimes those replenish cycles change over time. This map at the bottom of the page gives you an idea of where they do their production and manufacturing. Hanesbrands operates in basically 4 segments: innerwear, activewear, international, and direct to consumer. The innerwear is their largest, representing around 45% of revenue and having the highest operating margins. That's followed by activewear, then international, and then direct to consumer. International is probably their fastest growing segment, and direct to consumer is where they're spending the most money percentage-wise, reinvesting back into the company. Over the last couple of years, basically from 2016 into 2017, they've seen a significant decline in their retail operations in North America, the retail stores that they sell into. And so they've been trying to find ways to bolster their online presence to compensate for that. And that's what they've been doing over the last 2 years. That's why you see the operating margins significantly lower than all the other guys. Hanesbrands is consistently number 1 or number 2 in the segments and geographies that it services. And so this gives you an idea of the segments and the countries or the geography that they're located in. Hanesbrands' business strategy is pretty straightforward. They want to sell more, spend less, and generate more cash and acquisitions. In order to sell more, their main focus is to expand their brand. And they're going to do it in 3 ways. The first way is geographically. So 8 out of 10 households in the United States use a Hanes products, whether it's Hanes or Champion or Maidenform. 8 out of 10 households are represented by Hanes. And that Hanes brand, even though it's a US-based brand, has a global recognition, very similar to other US brands like Nike or Levi or McDonald's. Currently, Hanes is in 35 countries, and they recently expanded into Australia and New Zealand with their purchase of Pacific Brands in 2016. Their main focus is to expand that brand through acquisitions. So instead of trying to do it organically and grow the Hanes product in these countries, what they would rather do is expand into countries where the market, the underwear market, is a little more fragmented, and acquire a company, a well-known company there, and then use that platform to bring in its other brands and expand its other brands into those countries. Just to give you an idea, in the United States, the top 5 brands represent 90% of the market share for the underwear industry. And when you go outside the United States, it starts to fall off. And in Asia, it usually falls off into the mid to low 40s. So this is sort of a demonstration or representation of what happens in mass merchants, such as Target or Walmart. You'll see a Hanes product, you'll see a Fruit of the Loom product, you'll see a Gildan product. And when you look at it, the way they package it, the style of it, the material, and the price are all exactly the same. The same is true in the mid-tier and department stores, except Hanes is slowly moving into this area. This is one area that they're having a little bit of growth in North America. Not significant, but a little bit. And the reason is they are able to compete not only on the product, but also on the price. They're able to have a price that is significantly lower than Calvin Klein or Jockey. And part of that is that Calvin Klein commands a higher premium simply because of the brand. We were talking just a few minutes ago about the global international innerwear market and how those top brands and the saturation of those top brands. And so you can see in the United States, the top brands, the top 5 brands represent 90% of its market share. When you go into Europe, that falls off to about 50 to 80%. And then as we move into Asia, into the Middle East and Africa, you can see it falls off as well. So 36% is a very fragmented market for the innerwear market, and that's where Hanes just entered into. The global underwear market is a $220 billion market, with Hanes representing, well, not Hanes, but the US representing around 21 billion of it. The second way they intend to expand the brand is through innovation. So as I showed you in the US, it's highly concentrated, highly competitive. It's truly a commodity business. And in a commodity business, branding truly matters. And it takes years to build a brand. And Hanes has been doing this for 116. So they've had a little bit of experience doing that. What they have found is that when people go out to buy underwear, there are 5 decision makers they have: brand, comfort, fit, style, and price. Brand being the number one defining the number one driver, where price is the number 5 driver. But behind that, it's really about comfort, fit, and style. So if you go out and you purchase a pair of underwear, it's comfortable, it fits well, and you like the style, then you're just going to continue to buy that brand. So by default, your brand decision is based on your comfort, fit, and style. What is also important to understand is that Hanes spends about $70 million a year on research and development. And you're probably thinking to yourself, what could they possibly be spending that kind of money on? After all, I mean, this is underwear. It doesn't expire. There isn't a lot of changes in fashion over a short period of time. However, it's all about creating the brand. And research and development leads to innovation, and innovation leads to pricing power, and pricing power leads to brand recognition. So the idea is, over the last 15 years, they've come out with probably 4 different innovations within underwear: Tagless, Comfort Blend, X-Temp, and Flex Fit. All of it is about creating comfort, style, and fit. And when they do that, then they're able to differentiate themselves from either past underwear that they produced or others that have produced, and acquire a higher average selling price because of the innovation that goes into it. And creating this pricing power is especially important during times of inflation. The third way they intend to expand the brand is through advertising and marketing. Hanes spends about $175 million a year on advertising and marketing, and that represents about 3% of revenue. To put that in perspective, other commercial brands out there, other consumer brands out there, like Nike and Under Armour, spend anywhere between 10 and 15% of their revenue on advertising and marketing. So this is a significant low amount of money that Hanes has been spending. Part of that advertising and marketing actually goes for in-store advertising, kiosk displays and banner. The other part goes to people like Michael Jordan, who has been a spokesperson for Hanes for nearly 30 years. And he is probably the best spokesman they could have for 2 reasons. One, he's athletic and looks good in their clothing. And second is, he unto himself is his own global brand. So when Hanes is putting together an advertising campaign, they can use Michael Jordan in any of the countries in which they sell their underwear into. One of the areas that they've been focusing a little more attention to most recently is their social and environmental responsibility. And this also comes under brand recognition and advertising. They have this website called hanesforgood.com, in which they talk about the amount of renewable energy that they've been using, and the amount that they've reduced their carbon footprint. It's all about creating a social awareness for their product and how they're being responsible actors on the global stage. What they have found is that the group that is going to become one of the strongest buyers of apparel in the next 3 years are the millennials. And the millennials really identify with social and environmental responsibility. In terms of spending less, it's all about leveraging the infrastructure. Over the next 3 years, Hanesbrands expects to be able to cut its expenses by $150 million. And where that's going to come from is both on the production and global supply chain that they have, as well as on corporate SG&A. So they have a global supply chain that we've talked about and a global production. And part of it, where they start to see the benefits from that, is the more volume they can put through that system, the lower their expenses become. So as they do acquisitions, one of the things they do from an acquisition point of view is that they're now able to take all that production that was happening outside of their platform and put it onto their platform. In addition to that, they're able to do more quality control in-house, which reduces the defects and also the time to market. All these little kind of incremental changes that they do has a big effect on their cost of goods sold. Over the last 8 years, what we've seen is that the gross profit margins from Hanes has grown from about 32% to nearly 39%. And the revenue has increased by around 53%, where the cost of goods sold has only increased by 30%. Now they're looking to do something very similar on the SG&A side of things and using technology and automation to take care of that. And they're hoping to get their SG&A where it lags revenues by close to 50%. They also work very hard on inventory management, and this is about managing their SKUs as well as their transportation costs. If they can reduce their transportation costs and by managing their inventory in a significant way, then they can put their products on ships rather than planes and on trains rather than trucks. And in doing so, again, this is another way for them to continuously reduce the expenses that they are paying on a year-to-year basis. So if you sell more and spend less, you're going to generate cash, and and that's what Hanes does. It generates a significant amount of free cash flow. Over the last 10 years, they've increased their free cash flow by 150%. And what management is being very clear is that they're in a position now where the free cash flow is to be returned to shareholders, and the debt structure is to be used for acquisitions, and I'll talk about that in a second. Over the last 5 years, they have returned about $730 million to its shareholders in terms of dividends. It has currently about a 3% dividend yield, and each year since they started their dividends, they've raised it annually. The buybacks over the last 3 years, or almost 3 years, they've done about $1 billion, and they're looking to do about 14 million shares a year. One thing I'd like to point out is if you look at that cash flow, CapEx, and free cash flow graph at the bottom right, what you'll see is that there's this red line that represents CapEx, and that CapEx line has been relatively flat since 2004. In fact, their CapEx represents less than 2% of revenues. For a company that's a manufacturer, has a global supply chain, and does some of its own production, that is a significantly low amount of capital expenditure to have to place into your company every year. Acquisitions is the next area that they're going to focus on, and they have a very specific criteria. They have a very specific criteria that they've set up. They want it to be part of their core segment. They don't want to venture outside of it. They want the acquisition to complement their growth opportunities either through segments, channels, or geographies. They want it to have synergies, either leveraging their supply chain, production, and SG&A. Hopefully they can do all three. That would be optimal for them. And it has to be accretive within the first year, and that includes the integration costs that go on. So to pay for this, Hanes has been using its balance sheet. It's been using its debt. And we talked earlier about that sweet spot being a 2.5 times net debt to EBITDA. They feel comfortable in expanding it slightly out of the range when they're doing an acquisition. However, they want it to immediately flow back in a reasonable time, being 1 to 2 years, flow back into that 2.5 range. So when they did all those acquisitions between 2013 2016, their most recent one was Pacific Brands. That was $800 million. So they put about $1 billion of debt on the balance sheet to cover that acquisition. It took them outside the range to about 3.7, 3.8 times net debt to EBITDA. Currently, they're at 3.2, and it's expected that within the first quarter, they're going to be back under right around 3% or slightly below 3 times net debt to EBITDA. When they do these acquisitions, in the last 5 ones that they've done, is they pay about, on an EV to EBITDA ratio, they pay about 9 to 12 times EV to EBITDA. However, because of their ability to move everything into their own production as well as reduce expenses, they're easily able to cut that by half in about a year's time. Now, we talked about the acquisition and integration. The costs that go along with that remain flowing through the income statement for about 2 to 3 years. It runs the company somewhere between $50 to $150 million, depending on the size of the acquisition. The one that they recently did with Pacific Brands is probably going to be closer to the higher end of things. But when it really becomes expensive is when it's across many geographies that they have to integrate, or they have to integrate it into many segments of their business. So when I look at Hanes, what I really think of is a company with a significant competitive advantage in 3 areas. The first one being its brand. It's either number 1 or number 2 in the segments that it operates in, and it does so by carrying a very low advertising and marketing budget. In terms of its infrastructure, it's able to leverage that infrastructure, and it's able to do so on not only the global supply chain, but on its inventory, and we mentioned about the SG&A. So when they bring a new company into the fold, it immediately becomes accretive within the first year. And on top of that, it continues to expand through the global supply chain and through its inventory management. One thing to point out about its inventory management is that unlike other apparel manufacturers, its underwear is not seasonal. It doesn't change over. And even if they have extra inventory in, let's say, the end of this year and let's say in the end of 2017, they can then deplete that into 2018. They don't have to worry about marking it down or being promotional about it to get it out to make room for no inventory. They control the entire chain, so it's very easy for them. And oftentimes what they'll do is if they're able to get very low prices on cotton or some of the components that go into it, they may overload on their inventory knowing that they will just reduce production in the months and weeks to come. What I think is really the secret sauce of Hanes' competitive advantage is their management. This is a management that has been battle tested over the last 11 years. When they first went public, they had a highly levered balance sheet that they had to work very hard to reduce. 2 years later, they're in the midst of a financial crisis. 2 years after that, they watched cotton prices spike over 200%. And currently, they're in the last 2 years, they've been in decline in retail, both in bricks and mortar, mall traffic, store closures, bankruptcies, all that in North America where they represents a significant portion of their revenues, and they've been having to deal with all of that all at the same time. But what I think management is really good at doing is creating value for the company through the acquisitions that it makes, as well as for the shareholders by returning money to its shareholders through either dividends or through buybacks. So the question is, why is Hanesbrands hidden in plain sight? If everything I've talked about seems reasonable, why isn't anyone picking up on the story? And I think the reason is threefold. One is they don't fit, just like Sherwin-Williams, they don't fit into a specific investing strategy. They're not a growth stock. Their revenues are only growing around 6 to 8% a year, and many people consider them too expensive to be a value stock. In terms of acquisitions, and in terms of acquisitions, it truly masks the true economics of this company. It takes 1 to 3 years for them to fully achieve synergies amongst the acquisitions that they make and cost reductions. And it takes 2 to 3 years for those integration costs to work its way through the income statement. So oftentimes, the true earnings power of this company isn't being reflected accurately. And then you have to look at the environment that we're in, which is the retails. I mentioned it a few minutes ago about bankruptcies, store closures, and declining mall traffic, which is all leading to liquidations and destocking and slower replenish cycles, which is negatively impacting their margins as well as their inventory. So in terms of the valuation, let me just walk you through it, and we can all determine whether or not it's cheap or not. I look at Hanesbrands' valuation for using its earnings per share for this upcoming year, which is estimated to be about $2 to $2.10 per share. So I put together a bear case, a base case, and a bull case, and to walk you through it. On the bear case, what I'm looking for is continued store closures, continued decrease in mall traffic, still pressuring their margins, and an earnings per share of $1.90. And if you throw a 10 multiple on that, we can get $19. I think stock is trading around $21.60 today. So you can see that there's some downside movement to that. However, keep in mind that you're getting a 3% dividend. So even though there's like a 10% or a little bit above 10% movement down, you're getting paid 3% to wait. The base case is where everything in retail stabilizes. And what you get is margins are flat, revenues are flat, and they hit their earnings per share of $2 to $2.10. So I put a 12 multiple on that, and I get you to $25.63. The bull case is where retail starts to rebound, the margins are improving, the direct-to-consumer segment, which they were spending a lot of money, starts to really catch hold and starts to add incrementally to that, as well as their expansion that in all the acquisitions that they have done over the past 5 years start to play a role in the company's economics as well. I put a $2.40 earnings per share on that, 13.5 multiple, and I get you to 32.40. If you look at this and someone were to show this to me, I wouldn't be too impressed, because I would say it doesn't seem like there's significant upside to it. But then I had the experience with Sherwin-Williams, and I believe that Hanesbrands and Sherwin-Williams are very similar to one another. And if we wait 10 years, we could be very pleasantly surprised by what we see from Hanesbrands. So from the time that I bought, from 2006, the year that I bought my investment in Sherwin-Williams, and if I'm saying that if I held it for 2016, that 10-year period, what we would have seen were revenues that grew about 4.25% on a year-in-year-out basis, net income that improved by 7% on a compound annual growth rate, and an earnings per share of 11%. What you also see is a PE multiple that expanded from 12 to 25, and a share count that was reduced nearly 4% a year, and a $2.3 billion worth of dividends that were returned to shareholders. When you put all that together, that is what creates our 680% return that we got from, or we could have gotten, I didn't get, but we could have gotten from Sherwin-Williams. On another note, if we continue to hold it through today's market, it would be closer to 900, basically 1,000% return, or a 10-bagger. If we use those same kind of metrics and apply them to Hanesbrands, what we see is we can get nearly a 400% return. And I'm actually being a little bit conservative in certain areas, like the share repurchases. Instead of doing 14 million shares a year, I'm only accounting for 11 million shares. And the dividends, I'm kind of equating it to where Sherwin-Williams was, but also this falls in line with what Hanesbrands has guided to, which is that they want their payout ratio to be somewhere between 25 and 30% of their net income. So that's where I'm getting the dividends from. And in terms of the net income, the growth, I'm using the same as Sherwin-Williams, which I think is really reasonable. And if you look at the net income profit margins in 2017 and 2027, they grow from about 9% to about 11, a little bit slightly above 11%. Again, I think these are very reasonable, if not conservative numbers. And I think that if you follow this, and if Hanesbrands management continues to operate in which they said they intend to, we can definitely see this type of return, maybe even better, over the next 10 years. So with any investment comes risk, and Hanesbrands is no different. The risks that I've associated with are political and economic, which is basically taxes, regulations, and tariffs. And then, of course, the economic slowdown, especially in the US. If that were to happen, that would be negatively impacted the company. But however, they lived through this before. They've done it through 2008 and 2009. Their earnings never went negative in 08 or 09. And they were able to weather the storm with the commodities as well. In terms of the financial, the risk that you run there is the company overextending itself, either by putting too much leverage on, too much debt on its balance sheet, or using up too much of its cash flows to try to repay shareholders, or for paying too much from acquisition. The one thing I would say about this is, given how this company has behaved over the last 11 years, I don't think it's something that they would be focused on. I think initially this is a very conservative management team that understands the place and role that they operate in. They are not a growth company, but they are a way they can grow through the value that they create through the acquisition, but also through the shares, what they've returned back to their shareholders. And then the final area of risk is commodities. And again, in 2011, commodities prices spiked in cotton from over 200%. And the company was able, the company being Hanesbrands, was able to pass that along to its customers. And so I think that speaks a lot to the brand that they've created over the 116 years. So with that, I will open it up to questions.
Barry, thank you very much for sharing such a unique, interesting, and perhaps obvious idea. That was terrific. If we could please turn back to slide number 7 for a moment.
Yep.
There clearly has been quite a bit of activity at the management level in recent years. Could you please elaborate on how you handicap insider incentives?
So the way that management is rewarded in the way that management is incentivized and rewarded isn't through growing it's mostly on free cash flow. It's also on not how many acquisitions they make, but how well they can integrate those acquisitions. So when I talked about earlier where they said they want to be accretive within 1 year, and that includes incentives, that puts an extra burden on them because not incentives, the cost, the integration cost. That puts another burden on them because the integration costs can be anywhere from $50 to $150 million over a period of time. And so in doing so and taking on all of these acquisitions all at the same time or relatively in short order, put a lot of pressure on them. But they did so because they think in the long run it creates value for the company. And not only for the ability to have additional brands and different footprints, but also to leverage that global supply chain. And it really focuses on what kind of free cash flow that these guys can generate over a period of time. And that goes back again to that graph I showed you where they're spending CapEx. Their CapEx spending, they've recognized it. They don't have to spend a lot of money on a year in, year out basis to keep this global supply chain running. They pay a very, what I would call, minimum amount of CapEx and a minimum amount of revenue to maintain that brand. And I think they recognize that. And it sort of goes back to what I was talking about in the beginning, which is that if you have a free cash flow generating company with a management that is focused on creating value not only for its shareholders, but for its brand as well, I think that's a really disruptive power you have.
And jumping to slide number 14, please, which I thought was very eye-opening. I noticed that you have Fruit of the Loom front and center with the exact same apparent key metrics. I believe Fruit of the Loom is a Berkshire Hathaway-owned subsidiary, and I assume that Warren Buffett looks for long-term compounder-style businesses. To what degree is a comparison of Fruit of the Loom with this company an appropriate rabbit hole to go down?
I'm sorry, in terms of?
In terms of everything. In terms of, are the economics similar? Would the pricing trend
Yeah, I think so. I don't know the full history about Fruit of the Loom. I know they were bought out of bankruptcy in 2002, and Warren Buffett basically took care of the debt and took over the company. And I think what he saw is what Hanes is publicly talking about, which is that you have an infrastructure that you can leverage. So the more that you can put through the system, and Buffett has always talked about his main focus is building a brand and having a brand. Fruit of the Loom is obviously a very strong brand, and it's a little bit difficult to know what they're doing behind the curtain of Berkshire Hathaway. But my guess is when you look at Hanes, when you look at Fruit of the Loom and look at Gildan, and Gildan is a Canadian company that is public, and you look at Hanes and Gildan, they're very similar in the way they operate. It isn't like they have a secret sauce that nobody knows about. I think they understand where they operate and what their competitive advantage is. And I think the reason why Warren Buffett bought them, not only because he probably got a really good deal in doing so, but I think he recognizes that this is a long-lasting brand. I think Fruit of the Loom is like a 150-year-old company compared to Hanes at 116. And I think he understands what he has with Fruit of the Loom, which is a cash-generating machine. And as long as they don't screw anything up and do something or do an acquisition that is going to over-lever the balance sheet, Fruit of the Loom is going to do just fine. The one thing that I think Hanes has been doing, and I can't speak to Fruit of the Loom, but I can speak more to Gildan, is that they're really trying to expand the brand through acquisitions and improving outside the United States. I think that when Hanes looks at the United States, and they get a lot of criticism from different analysts that I've read, which says that they should be spending more money on advertising to build up their market share and take a little bit more market share in the United States. I don't think that is money well spent for Hanes. I think they much rather use that money to go outside the United States where the competition is less, and use their global supply chain and use their brand to expand out. It's the land and expand versus trying to beat your partner up and grab maybe a percentage of market share.
I would imagine that the cost of goods sold to produce 5 units of underwear in Bangladesh or Sri Lanka or Haiti is probably less than $14, which might imply an opportunity for a house brand to gain some market share, or at least gain some shelf space. How do you think about the issue that there might be a very high markup and possibly additional routes to market in the 21st century?
So I would bring it back to, where is that? I would bring it back to this slide here, where we talk about the drivers. And if you look to the brand, the comfort, the fit, and the style, and the price, also what Hanes has found out over the years is that the branded share market, meaning Fruit of the Loom, Gildan, and Hanes, represents 85%. 15% is in private label. And it's one of those things, Shai, where underwear is probably the least of your concerns every morning. You have it in your drawer, you put it on. If it fits nice and you're comfortable with it, you don't think another thought about it. To go out and save $3 to get a Costco's, let's say Kirkland brand versus Hanes brand or versus Fruit of the Loom, I don't think people are looking to, that's where people are looking to save money. I think they feel it's this loyalty that they get. And unless something changes within that loyalty, they're going to buy they're going to buy their brand, whether it's Hanes or Fruit of the Loom or Gildan.
And moving to slide 20, please, if we could. I am noticing that the cash flow from operations does seem to jump around a bit. I would imagine that during the recession there would be some movement, but there was a meaningful 2015 movement. How do you talk about how should we understand the non-linear direction of the CFO?
Yeah, so I would say in the long run it's linear, and what you see is some hiccups. I sort of made reference to it when from time to time what they'll do is they overstock their inventory. 2015 was kind of the beginning of the downturn in retail. And so they were using, let's say, 2014 numbers and expecting continued expansion of 6 to 8%, let's say. And that's when the big box retailers, that's when we started seeing some bankruptcies on the sports, on some of the sports retailers, as well as decline in inventory and demand from some of the other mass merchants. And so they spent all this money in terms of cost of goods sold and to build up their inventory, and then their inventory wasn't used. One of the good things that I mentioned is that inventory, even though they didn't use it in 2015, they paid for it in 2015, but didn't get to use it in 2015, it immediately returned in 2016. And so if you look at the cash flow statements and you look at the part where it says inventory, you'll see a downturn in 1 year and then a reversal in the next year. And sometimes they do it because they're able to get better pricing. Sometimes they've seen it. They have problems with their pricing, let's say for cotton, that drives it. But oftentimes it's not like that inventory is going to go. There's a risk of that inventory spoiling or going out of style or going out of season. They just reduce production going into the beginning of the next year until they can wear down their inventory and move on.
And if we could please turn to the final slide with your contact information.
That one?
Perfect. So we very much appreciate the time you've shared with us. We know your time is limited and valuable. And also want to recognize you're a returning Best Ideas conference instructor, so thank you for your loyalty. I'm wondering what type of feedback from the audience might be most valuable to receive.
Yeah, so I'm open to any type of feedback, whether you think I've missed something, or if you think my thesis is completely wrong, feel free to contact me and explain why you want to do it or why you think that is the case. The best way to contact me is initially through email, because I don't usually have my phone on during the day. So the best way to contact me is email, and if it warrants a further conversation, I'm more than happy to talk to people over the phone. But I'm more than happy to receive any type of criticism, or if people want more clarity on something, I'm more than happy to talk about it.
And I believe you're based in Chicago. Are you open to having coffee, perhaps, if anybody is passing through town?
Yeah, I mean, I'm open to it. The truth is that during the day, I'm mostly tied to my desk. That's unfortunate to say, but that's usually the case. I don't want to promise something that I can't deliver, but I'm more than open to doing it.
Terrific. So once again, Barry, it is an honor to have you here at Best Ideas 2018. Thank you very much for sharing with us your insights, and we hope to see you back in the future. Thank you very much.
Thanks, Jack. I appreciate it.